Hello and welcome to It's Markets Uncut podcast, your weekly insight into the topics and issues that we've been discussing here at It. I'm Dan Jolliffe, an investment manager based out of our Jersey office, and I'm pleased to be joined by regular commentator and head of fixed interest research, Richard Carter, and It's head of equity research, Chris Beckett. Welcome both. So the headlines last week were dominated by the UK election and ultimately Labour's triumph. And we will come on to talk about that in more detail later on the podcast. For those who specifically want to focus on the UK election outcome, I can thoroughly recommend the general election update of the Taking Stock After the Bell podcast, which is available on the website and was recorded on Friday. Today, for most of the news relates to the second round of the French election, where rather unexpectedly the Popular Front won the most seats rather than the National Rally as anticipated. The overall outcome is one of uncertainty due to a fragmented coalition. So, Richard, at the time of writing, there's been very little, or should I say talking, there's been very little reaction from financial markets regarding the outcome. With French equities performing rather flatly so far today. However, in the long run, what do you see as the potential consequences of a hung parliament in France?
Yeah, that's right, Dan. I mean, not great to be honest. I mean, it's good news that the National Rally, haven't won a majority, and even the Popular Front didn't either. But it's clear we're in for a sort of a few weeks at least of uncertainty while they try and cobble together some sort of coalition. Hopefully, sort of moderate centre left. I think would probably be okay with markets. But yeah, a hung parliament means it's going to be hard to get things done. And truth is, France, its deficit is too big and it needs to get it under control, and that means taking difficult decisions. And I'm afraid when you've got political uncertainty and sort of vague coalitions that could break apart at any moment, it's going to be quite difficult to get things done. So I suspect it won't be maybe we have more elections in the future, and also the power of Macron and all the rest of it might come under a bit of scrutiny. Whether he's going to last a full term it must be a little bit open to question. But for now, as you say, market reaction has been relatively okay. The hope is that the more extreme elements of the left wing will be kind of excluded from the government talks, and a fairly moderate coalition will come into being.
Great, thank you. We're jumping around geographies a little bit, but in the build-up to the UK election, there's been a lot of consternation from clients regarding the potential impact of a Labour victory, whilst a lot of uncertainty remains regarding the impact of their policies. The impact of the result on financial markets was, again, a similar thread to what we've just discussed. It was fairly muted on Friday, with the FTSE only kind of marginally down. Aside from the kind of UK election excitement last week, there was some key economic data that was released in both the UK and the US. On Friday, the latest US jobs release data indicated that whilst more jobs were added than anticipated, 206,000 were added versus an anticipated 190. The overall level of unemployment had risen to 4.1% from 4%, which is the highest level since November 2021. Another positive was that non-farm payrolls for both April and May were revised down. In regard to the UK, on the 1st of July, there was the latest UK PMI manufacturing data, and it had dropped from 51.2% to 50.9%. So I know there's been a lot of numbers that I've just quoted, Richard, but can you provide your view on both data releases? And most importantly, does either data release aid the decision of the Fed and MPC to cut interest rates?
Yeah, I think that's right, Dan. I think that particularly the payrolls were sort of consistent with what we've been seeing over the last few weeks, which is a gradual softening of the US economy. Nothing to get alarmed about, but just a slight easing off of the pace and some sort of weakness, gentle weakness starting to come through in the labour markets. And it's still at a stage where, as far as markets are concerned, that's probably good news, because it means the inflation risks are a bit less, and that sort of potential interest rate cut from central banks are getting closer. So I think that was taken quite well. Like you say, the unemployment rate ticked up, and the previous payroll numbers were revised down. And also, as you mentioned, some PMIs recently ticking down a little bit as well. So yeah, the bond market had a good week last week, and we haven't quite got there yet in terms of rate cuts, but it looks like potentially September could be an option for the Fed, and both really for the Bank of England and the Federal Reserve as kind of 50 basis points of cuts priced in, which looks fair enough if this data continues.
Great, thanks, Richard. So, Chris, over to you. An article in the FT over the weekend provided a view that Labour's victory and their significant majority could enhance the appeal of the UK market to foreign investment due to the UK's newfound political stability. I think it's fair to say that compared to other international equity markets, the UK equity market can often be somewhat negated. So, what is your take on the outlook for UK equities post-election?
I think after the election, it's a little bit better, but it's not really a game changer. It's okay as an equity market. It's a cheap valuation, but there's some structural issues going on. UK equity market is very unloved by international investors. We've got structural economic issues that got exacerbated by the self-inflicted pain of Brexit. We've had a very unstable government. We've got exposure to unattractive sectors or unloved sectors within the market. That's led to consistent underperformance by UK equities versus global equities that has reinforced that view that this isn't a great place to invest. UK equity markets underperformed by 54 percentage points versus global equities in the last 10 years. And if you just go from the market lows in October 2022, it's underperformed by 21 percentage points. A lot of that is the lack of exposure to technology. UK large cap indices have got about 1% exposure to technology. The US has about a third of the market. I think to your question, the election, it's a positive, but it's not a real game changer. It doesn't increase our expectations of economic growth yet. Despite the ambition of the incoming government, there's not much they can do to improve the potential of the economy quickly. The sort of reforms which are needed would pay off over decades rather than months and years. But at the margin, one or two of the things that the new government are doing, improving or relaxing planning controls, better relations with Europe, easing trade barriers, all of those could be a positive. But at the same time, low valuations are attracting a number of takeover bids for companies that we own within the UK. Nice to our short-term performance, but we struggle to replace those companies with equivalent high-quality businesses. So UK market is cheap for a reason. It's trading on 11.4 times forward earnings versus the US on 21.5 and Europe on a slightly more reasonable 13.6. To like the UK market going forward, you have to like the energy sector, the mining sector, healthcare, banks, consumer staples. Those together make up more than half of the market. And from that list, it's only really the domestic UK banks that I can get excited about, both on valuation and prospects. So I think our net is we wouldn't really want to be underweight the UK because we recognize that it's cheap, but we wouldn't want to get too excited because we recognize the reasons why it's cheap.
That's great. Thank you very much, Chris. Just staying with you, doing kind of my weekend reading, another article focused on US small cap stocks and how a potential soft landing in the US could provide a good opportunity for investors, as small caps tend to have a closer correlation to the health of their home economy. What's your view on this?
I think, as Richard was saying, the US macro situation has been improving, or we sort of live in an upside down world where bad news is good news at the moment. Getting slightly weaker economic data, particularly the employment data that you've just been talking about, improves or increases the chances of interest rate cuts. And that's what the market likes. So it looks like the Federal Reserve can achieve what is very rare in historical terms, the so-called soft landing. If I look at small caps within that market, those what we call a small cap in the US can be very large companies. If I take the bottom 4% of the MSCI North American Index, those companies at the upper end are $15 billion companies. So they can be quite substantial businesses, but still be classified as a small cap and still be sort of overlooked by other investors. They are more domestic, but not that much so. US small caps have about 90% domestic exposure, so sales from the US and Canadian economies. The average US economy, including large caps, is about 73. So the US market is far more domestic than other places we look in the world. If I look at valuations, small caps and mid cap stocks are on record discounts to the large caps. The great performance that we've seen, particularly in mega cap technology stocks, have left small caps overlooked, and that valuation discount does give us an opportunity. If I look at the sector exposure of small caps, it's more diversified than large cap. You haven't got that skew towards IT, the AI exposed names, and sort of associated technology companies. So you get a better, more diversified, broader portfolio. As we go through the economic cycle, you've got one or two positives. Smaller companies tend to fund themselves by floating rate debt. So if we get the cuts in interest rates and a knock-on effect to bond yields, you can get the funding costs for those companies coming down with a direct P&L impact. They tend to be higher growth, earlier stage companies, longer duration assets. So again, if you see bond yields coming down, just the way the maths works, how we value companies, you get a better improvement in the valuation of those companies. And history would suggest that they perform well in the year after a peaking of interest rates. So a lot of things going for those companies, and we get good exposure via our fund selection team, looking at the best small cap US external managers and try and get it that way through our portfolios. So quite a lot of interest in the sector and ways that we can gain exposure for our clients there.
Great. Brilliant. Thank you very much. And finally, Richard, back to you. We've kind of alluded to this already, but this morning I had a kind of a Reuters update that stated there is currently a 76% chance of a US interest rate cut in September. Do you feel that those odds are realistic? And if a rate cut is going to happen in September, what has to happen from now until then?
Yeah, Dan, I think that's fairly realistic. I mean, I think it's what we need to see is more payroll numbers like we had this week, or unemployment numbers. If we see a gentle tick up in unemployment, a bit of a softening in the payroll kind of pace of job creation, then a rate cut in September would probably make sense. I mean, we're going to hear from Jay Powell this week. We've got CPI inflation numbers as well. So, hopefully we won't get any sort of difficult, nasty shocks on the inflation numbers between now and September. But like I say, I think the direction of travel at the moment suggests that a September cut is possible. It'd also be a little bit before the election as well. So in terms of timing, it probably wouldn't be the worst time if they were looking to cut. It would be early enough before the election to do it. So I think it's quite possible. But increasingly with the politics in France and here in the UK and obviously in the US with Biden under a bit of scrutiny, that might dominate market sentiment more than whatever the Fed does. But clearly it looks like I think we're heading in that direction.
Brilliant. Thank you. So That's all for today. Richard and Chris, thank you very much for your insights. Before we draw to a close, if any listeners have any questions they would like to ask one of our analysts for a future podcast, you can put your questions forward to our team of experts by submitting them via the weekly comments page on our website. We'd very much love to hear from you. To stay up to date with our thoughts on markets and current issues, please visit our website at www.quiltercheviot.com. Here you can also see more of what we're doing at Quilter Cheviot, as well as watching post webinars on demand and subscribe to our weekly comment newsletter. We'll be back again next week. And in the meantime, for those of you on social media, you'll be able to see up-to-date content on our Facebook, Instagram, Twitter and LinkedIn pages. So once more, thanks again to Richard and Chris for their time today, and to you all for listening. Thank you.